value of about 11.7 billion, enterprise value of about 16.5 billion. And if we look at that in terms of valuation multiples, if we look at our LTM multiples, we see that Heinz is trading at about 1.6 times revenues. Remember, the interpretation of that is for every dollar of revenues Heinz generates, the market rewards Heinz with $1.58 of enterprise value. Okay, for every dollar of EBITDA Heinz generates, the market values that at $8.90. And for every dollar of EBIT, the market values that at $10.60. All right. Again, next week we'll figure out why do these multiples differ, what do they mean, and how do we use them. But that's the goal, and we've accomplished that with Heinz. We've calculated our enterprise value, calculated our equity value, calculated our multiples. All right, so at this point we're done spreading Heinz. And if we go back to our comp sum tab, now we'll see that the data for Heinz is now residing in my comp sum tab as well. So all of those multiples, we've set up links to link to those from our comp spread tab. So your homework, again, you're going to spread General Mills and Kellogg in your comp spread tab. Once you've done so, you're going to link to that data over on your comp sum tab. So for your stock price, or for the ticker symbol for General Mills, you would say equals, control page down, and you'd go to that ticker symbol, which is in cell G4 on the comp spread tab. For the share price, equals, control page down, find your share price on the comp spread tab. It's kind of a tedious exercise, but it's going to give you some practice at linking and also doing the control page up, control page down, navigating around. Okay, one other thing that you should do is once you have a complete data set, all right, that is you've got not just 3 multiples in each category, but you've got all 5, I want you to also calculate the median and the mean of each each grouping. Okay? The mean is obviously an average. Everybody know what a median is? Yeah, if you take all 5 and you line them up high to low, median will be the middle value. All right, so sometimes we look at medians, sometimes we look at mean. I'll talk a little bit more about when we would use a median versus a mean next class. All right. Let's talk about, I'm going back to the slides. This next slide, selecting multiples and ranges, I'm going to skip this for now. We'll talk about this next week after you've done a full spread exercise. When we've got a full data set, we'll talk about selecting multiples. I think it'll make a lot more sense once we have a complete data set to work with. All right, so we'll talk about that. Next thing I want to talk about is precedent transactions, our second of our 3 valuation methodologies. Also going to be a valuation methodology based on using multiples. So like comparable companies, it's going to be a relative valuation methodology. And a lot of folks, including myself in many circumstances, think this is the best way of valuing a company, particularly if you're looking at a controlling interest transaction or trying to get to a controlling interest value. We're basically going to use a precedent transaction approach, look at acquisition of controlling interest of similar companies in the marketplace, hopefully recently, figure out what the implied valuation multiples were from that transaction or those transactions, and then apply those to our subject company, our company A in this case. And so that's basically what's going on in a precedent transaction approach. Again, I think it can be a very accurate way of estimating controlling interest values because it's looking at real-world transactions. You know, where one company bought another, this is what they paid, this is the control premium, these are the valuation multiples, etc. So I think it can be really useful. All right, when we talk about control premiums, we mentioned what they were earlier. We mentioned why they come, or how and why they come into play. Typically, they can range 20 to 25%. Actually, it's probably a little wider than that, probably 10 to 30, 35% in my experience. I think the food industry, when we look at all of our data, it's going to be roughly like 10 to 25%. All right. But when we're selecting deals or comparable transactions to look at, kind of like with our comparable companies analysis, we want to find situations where similar companies were acquired, where controlling interest is acquired in similar companies. All right, so companies engaged in the same line of business, companies that hopefully were about the same size as the company we're trying to value, hopefully were similar in terms of profitability. A lot of those characteristics that we talked about, what makes a good comp, makes a good precedent transaction comp as well. All right, and ideally, like I said earlier, we'd want something that was recent. You know, to look at data from 10 years ago when so much has changed in the markets, even look at data from like a year and a half ago compared to where we are today. All right, there's been a lot of volatility in the markets, and you know that would probably be of limited value the further back we go. Right? But everybody understand what precedent transactions are, how we're, you know, just conceptually how we're going to use them. All right, so if we're looking for transactions, usually the toughest part of precedent transactions is finding good data. All right, sometimes you just can't find any. Sometimes it's difficult to find data. Sometimes the only transactions you can find, maybe are, you know, company might involve private companies where very little is disclosed, might involve the acquisition of just a division of one business where they don't make a full disclosure, so it's hard to calculate multiples. All right, but assuming you can find the data, again, I think this is a really powerful valuation methodology. And typically we're going to find data from a number of different sources. If you work for a bank or a private equity fund, you'll probably have access to some databases like SDC, Reuters, Thomson, a lot of different data sources that will, you can basically search by industry, you can search by SIC code, you can search by keyword, and find different transactions that have occurred in the past. All right. You can also find data by looking at SEC filings. Remember what happens when a company engages in a material event? They've got to file an 8K. Acquisition activities are material events, so usually whenever there's M&A involving a public company, there's an 8K associated with it. Bloomberg, yeah, I mean a lot of data sources. Yahoo Finance will announce acquisitions. You can find information from press releases. You know, anytime a big deal gets done, obviously there's a lot of press on it. Like I said before, equity research reports will probably talk about transactions in a particular space, industry publications, senior bankers, right? Especially if you work in an industry group at a bank, chances are they keep a running list. Anytime there's a new transaction, they just add it to the database. So most industry groups already have a collection of deals. Right? But again, assuming you can find the information can be a really good analysis to perform from a valuation standpoint. And the typical information we want to capture when we're looking at deals, right? Typically we want to look at, there's differences between when the deal is announced and when the deal closes. Differences in terms of the valuation on the deal, especially when stock is being issued as consideration. Okay, so the buyer issues stock to the seller. Well, the buyer's stock is going to fluctuate between the date the deal gets announced and the date it closes. Right? So there can be fluctuations as a result of that, and also be some acquisition transaction-related adjustments that occur from an accounting standpoint that change deal valuations. When we look at deals, though, we want to be concerned with what was the valuation of the deal as of the date it was announced. We want to best try and capture what was in the buyer and seller's minds as they shook hands and struck a deal. That's our best indication of willing buyer, willing seller, fair market value. All right, so we want to capture what is the announcement date, who is the buyer, who is the seller. Okay, most importantly, we're concerned with the seller. If we're valuing a company in the food industry, we're looking at precedent transactions. We want those transactions to be involving the acquisition of other food companies. All right, the valuation on a controlling interest basis of similar companies. Okay, so who was the buyer, who was the seller, and importantly, what was the line of business of the seller? It's also interesting to know what was the rationale of the deal. Okay, why is the buyer doing this? Why does the buyer think this is going to be a good transaction? It's interesting to understand that. Maybe they think it's a value play. They think the seller's just undervalued. Maybe the buyer's looking to expand. Maybe they can get some synergies. Maybe they can take a key competitor out of the marketplace. Maybe the CEO has a big ego. They just want to run a big firm. All right, interesting to understand those. Another key thing that we need to capture is what is the consideration of the deal? That is, how is it being paid for? generally three ways a deal can get done: 100% cash, 100% stock, or some combination of the two. Okay, we're going to see a couple different variations on that in the deals that we take a look at. The one we're going to spread in a minute, I believe, was an all-cash deal. All right, so we'll see that. But some of your homework, there's actually a stock deal in there as well, so you'll get to model that as well. Sometimes smaller deals, you might see earn-out provisions. What's an earn-out? Does anybody know? Earn-out is basically saying, we'll give you so much now, and you're going to stay on, help us run the business, and upon the achievement of certain milestones, you're going to get paid more later. All right? Again, usually in smaller deals, usually in situations where like a key person, maybe in the chairman or the prior founder, is going to stay on and help run the business post-acquisition. You don't typically see it in large public company deals. Usually the existing management gets taken out, and then all the shareholders get bought out and really don't have anything to do with the day-to-day operations of the company anyway, so it wouldn't make sense. All right, but that's what an earn-out is. And basically at the end of the day, again, we're trying to calculate multiples. So we need total enterprise value, we need market value of equity. All right, those are our numerators in our multiples. We need denominators, what were revenues, what were EBITDA, what was net income, etc. What does that mean in terms of the valuation multiples? We'll usually also calculate what is the control premium. Okay, and that's usually pretty easy to do. You take the price that they're paying for the equity of the company, you compare that to the stock price of the company the day or a week or a month before, and give us an indication of what that control premium was. All right, so that example I had very beginning of class today, buying a company, their current stock price is $10. If we buy it for 12, that's 20% premium. All right, real basic. Any questions? Okay, let's do an example of this as well, and then you're going to get to spread a couple others as the second part of your homework. All right, so what I'm going to do is I'm going to go back to my valuation template. I want to go to the Precedent Transactions tab. Now, you should probably follow along with me and do this one together. All right? This is not like the Heinz situation where I was just filling in data that you already had. Your template will be blank in this regard as well. All right, again, this is set up where this upper left portion of this worksheet is nicely formatted, providing a nice summary of several different transactions. What is the announce date? Who's the buyer? Who's the seller? What was the description of the seller? What did they do? Okay, as we scroll over to the right, we capture what was the seller generating in revenue and EBITDA in the latest 12 months leading up to the deal. What was their EBITDA margin? How profitable were they? What is the transaction value? That is, what is the implied enterprise value from the deal? And based on that, and based on the latest 12 months operating statistics, what were the multiples? Okay, this first deal that we've got listed here, Unilever acquired Best Foods. It was basically a $23 billion deal, which represented a 2.7 times revenue multiple, a 14.2 times EBITDA multiple. And it also involved a control premium of just about 16%. All right, so all the work we're going to do, when I say we're going to spread one of these deals, we're going to capture all the information necessary to populate this table up above. Okay, and I've given you several other transactions: Philip Morris, Nabisco, General Mills, Pillsbury, etc. The first one we're going to look at is actually the Mars Wrigley deal, which took place in kind of spring of 2008. Okay, Mars, which was a private company, went in and bought Wrigley, which was then a public company. Because it was an acquisition of a public company, there was a lot of information on the deal. We're going to look at that information, filter out all the information we need to calculate these multiples, spread that, and then we summarize it in this table. Make sense? All right, so Mars bought Wrigley. The announcement date was April 28th, 2008. I got real creative with the description here. Wrigley was a gum maker. All right, typically it's a couple sentences. Right? And then all these items over here, these are blank right now. We need to link to these, right? But right now we've got nothing to link to. Where we're going to spread the information on this deal, if you scroll down and to the right, we've included a space to capture the key details on this deal. Right? And everywhere it says input, we're going to be hard coding some numbers. So that's our goal here, is to populate this, all this information. Make sense? In the valuation folder, if you go into your valuation folder, you've got that comparable company data subfolder. You've also got a transaction filing subfolder. Right? That's where all our precedent transactions data resides. So we'll open up that folder. And for each of the 3 deals that remain to be spread in that table, we've got information on each. Okay, for Wrigley, we've got a press release, which we're going to open in a second. So the day the deal announced, they did a press release, gave us some key indications of what that deal, how it was, what the consideration was, what the price was, etc. Okay, we've got an 8K that they filed with the SEC because it was a material event that further described the transaction, so we're going to get some information from that. We also have a 10K, which will allow us to get latest 12 months information on Wrigley as well. The time the deal announced, 10K was the most recent filing, so we just need to go to a 10K. We don't need to look at a 10Q. First thing I want to open, the Wrigley press release. Okay, maybe what happened is somebody said, oh, you're valuing company A, it's a food company, you need to look at the Mars Wrigley deal. Happened somewhere around April 08. So we go out, we Google Mars Wrigley, we find a press release, and this is our first look at the deal, so to speak. Okay, so in the press release, Mars is buying Wrigley. They're buying them for about $23 billion. Okay, so we have an indication of the overall deal size. Okay, the funny thing about journalists, you don't know whether that $23 billion is necessarily total enterprise value or market value of equity. All right, just like I said before, anytime we get data on public companies, we always get it from where? SEC. These types of things are good for a first look, but we want to validate everything we see here with SEC filings. So I'm going to read the press release. I'm going to say that's great, that's fine, that's good, but I want to go and get the actual data I'm going to put into my model needs to be sourced out of an 8K. So this is what will typically happen. We'll get a press release, we can read that. It's basically saying $23 billion in cash. And I'm not going to read the whole thing. They're getting some financing help from Buffett on the deal. All right, so there's a little blurb in there from Buffett. It's really not all that key to the deal. We're really more concerned with aggregate value, not necessarily who's investing in it or who's providing the financing. Okay, what we want to see actually is toward the bottom here. This is the price. Wrigley shareholders get $80 in cash for each share of stock that they own. And then Mars is also going to assume about